the language of the market. Hello, friends, and welcome. Today, we are going to explore one of the most powerful ways to truly understand the financial markets: volume price analysis. Think of this as learning the secret language of the market. Every day, the market speaks to you through the movement of prices and the rhythm of volume. Most traders only listen to half of that conversation. They see price, the surface, but they miss the depth that volume reveals. Price tells you what happened, but volume tells you why it happened. Volume is not just a number on your chart. It's the heartbeat of the market. Every time a trade is made, it reflects participation, commitment, energy flowing into or out of the market. And just like a heartbeat, the rhythm of volume can tell you whether the market is healthy, weak, or about to shift. Once you start reading volume correctly, you begin to see the market as a living system, not random numbers on a screen. When price rises on strong volume, it means many participants are involved. It shows confidence and real buying power. But when price rises on weak volume, the move is fragile, like a house built on sand. It may look strong for a while, but it can collapse quickly. On the other hand, if price falls with weak volume, it might simply be a temporary pause, not a real reversal. Volume gives context to every move, every candle, every signal you see. Think of trading as listening to music. Price gives you the melody, and volume provides the rhythm. Without rhythm, the melody feels incomplete. The same is true in trading. Without volume, price action loses meaning. Many traders rely on indicators, algorithms, or complicated setups, but these tools often hide the simplicity of what truly matters. The truth is this: price can lie, but volume rarely does. Imagine watching a stock break out of resistance. Most traders see the breakout and jump in instantly, but a professional checks one thing first: volume. If volume doesn't increase, the breakout is weak and likely to fail. But if you see a strong surge in volume, it means the breakout is genuine. That's how professional traders separate fake moves from real opportunities. Volume shows the footprints of smart money, the big institutional traders who move markets. When they buy or sell, they leave traces in volume. By learning to read those traces, you can follow their actions instead of fighting against them. You stop being a reactive trader and become a strategic observer. And here's the real magic: when you combine price and volume, the market's message becomes clear. You can see where the crowd is trapped, where smart money is quietly accumulating, and where emotions are driving irrational moves. You no longer chase trades, you anticipate them. Volume price analysis transforms the way you see the market. It replaces confusion with clarity, fear with understanding, and randomness with reason. Once you start noticing how volume supports or contradicts price, you begin to hear what the market is truly saying. So as we begin this journey, remember this: the market is always communicating. It whispers through price and speaks loudly through volume. The more fluent you become in this language, the more confident, calm, and consistent your trading decisions will be. 2. The relationship between price and volume. Now that we understand that the market speaks through both price and volume, it's time to look deeper at how these two elements actually interact. Think of price as the surface of the water and volume as the current underneath. You can see the surface waves, but to understand the real direction and strength of movement, you have to look below. When price moves higher and volume increases, it signals growing participation. More traders and investors entering the market, supporting that move. This is a healthy sign of strength and conviction. It means that buyers are confident and that there's genuine demand behind the price rise. But if price up while volume remains weak, that move is hollow. It's like a balloon filled with air, but no substance. It looks strong for a moment, but can burst at any time. The same principle works in reverse. When prices fall on strong volume, it means sellers are serious. The market is under genuine pressure. But if prices fall on weak volume, it's often just a temporary dip or a pause before the next leg up. Understanding this difference helps you stay calm when others panic. Every movement on the chart tells a story. Imagine you're watching a breakout. Price surges above a previous resistance level. Traders rush to buy because they fear missing out. But the wise trader looks at volume first. If volume is low, it's a warning, a false breakout designed to trap eager buyers. If volume surges, it confirms genuine buying interest, signaling that the breakout is real. This simple observation can change your entire trading approach. You'll start trusting evidence over emotion. Instead of guessing whether a move is sustainable, you'll know based on participation. Volume becomes your lie detector, exposing false strength and confirming real moves. Let's take another example. Suppose you see a long green candle after days of slow movement, and suddenly volume spikes. That's a clue that big players, institutions, funds, or large investors are stepping in. They don't move in and out for small profits. They build positions over time. Watching for these clues allows you to trade with them instead of against them. In contrast, a rising price with steadily declining volume often signals exhaustion. The trend may continue a bit longer, but without fuel, it will eventually stall. The same way a car can't go uphill without enough gas, a rally can't survive without volume. Volume and price are like conversation partners. Price makes the statement, and volume confirms whether the statement is true. A healthy market move always has agreement between the two. When they disagree, you get signals of change. Warnings of reversals, traps, or the end of a trend. For new traders, one of the best habits is to look at both price and volume side by side. Don't just react to price action. Read the depth behind it. When volume supports the move, you can have confidence. When it doesn't, caution is your best friend. This relationship applies to all markets, stocks, Forex, crypto, or commodities, because it's based on human behavior, not on the asset itself. Wherever people trade, their actions leave footprints through volume. By following those footprints, you align yourself with the real forces moving the market. Over time, you'll begin to see patterns that repeat. Strong trends supported by solid volume, weak rallies fading without participation, and traps set by low-volume moves. You'll also learn to appreciate moments of quiet when both price and volume slow down. These pauses often come before big shifts, just like calm before a storm. So remember, price shows direction, but volume confirms strength. Together, they reveal truth. Ignore one, and you're blind to half of the picture. Learn to read both, and the market becomes clearer, more logical, and far less emotional. 3. Understanding patterns in market psychology. Now that you've begun to see how price and volume interact, it's time to explore how they form patterns and reveal the psychology behind every market move. Trading is not just a technical activity, it's a mirror reflecting human emotion. Fear, greed, confidence, and hesitation all appear on the chart, hidden within price and volume behavior. When you understand this connection, you stop reacting to emotion and start reading it. Every market movement has intent behind it. A price that rises slowly on decreasing volume may look promising to the untrained eye, but to someone who understands market psychology, it signals caution. The enthusiasm behind the move is fading. Buyers are losing strength, and sellers are quietly waiting for an opportunity. In contrast, when price begins to rise with volume increasing steadily, it shows confidence. A strong belief among traders that the direction is supported by real demand. Patterns form when collective psychology repeats itself. Imagine a stock that has been rising for several weeks. Suddenly, you notice that even though the price keeps pushing higher, the volume no longer grows. This means fewer traders are willing to buy at those levels. The uptrend is running out of energy. Then one day, a red candle appears with a burst of volume, a signal that smart money might be taking profits. These subtle shifts reveal what's happening behind the scenes long before the trend visibly reverses. Two of the most revealing phases in any market are accumulation and distribution. Accumulation happens when institutions start buying quietly after a decline. The price doesn't move much, but volume slowly increases. It's like a seed being planted beneath the surface. Once the buying phase is complete, the price begins to rise sharply, confirming the trend. Distribution, on the other hand, happens when these same players begin to sell their holdings near the top. Volume increases again, but price stops climbing. To the inexperienced trader, it may look like strength, but in reality, it's the preparation for a fall. Understanding these psychological stages allows you to act with awareness. Instead of getting caught in the excitement of a rally, you'll recognize when the enthusiasm is real and when it's about to fade. Instead of panicking during a drop, you'll know when fear is genuine and when it's exaggerated. Volume patterns can also expose hidden traps. For example, After a long sideways movement, a sudden breakout on low volume often lures impatient traders. The market appears to move, but without real participation, the move lacks foundation. Soon after, price reverses, leaving late buyers trapped. A similar thing happens on false breakdowns. Strong volume is the only signal that confirms sincerity. Without it, every big move deserves suspicion. Psychology is also why many traders repeat the same mistakes. They react emotionally, buying because everyone else is buying, selling because they can't handle the pressure of a falling market. But when you read volume, you see what's truly happening. You can tell whether the market's excitement has real backing or if it's just emotional noise. This insight helps you stay calm when others panic. The most successful traders learn to balance analysis with emotion. They understand that patience is not weakness, it's wisdom. They wait for price and volume to align instead of acting on impulse. They know that the best trades come not from chasing the market, but from waiting for confirmation. When you develop this understanding, trading becomes less about prediction and more about interpretation. Each candle, each surge in volume tells a story about what traders believe, hope, or fear. As you listen carefully, you'll start to see repeating emotional cycles: excitement, fear, exhaustion, and renewal, all visible through the relationship between price and volume. So the next time you look at a chart, don't just see it as data. See it as a conversation between human emotions and market logic. The patterns are simply emotions drawn on a graph, and volume is the heartbeat that tells you when those emotions are real or fading away. 4. Breakouts, traps, and the truth behind volume. Now that you understand how psychology shapes patterns, let's talk about one of the most critical areas in trading: breakouts and traps. Every trader at some point has fallen for a false breakout. It looks perfect. Price finally breaks through resistance. The chart looks bullish, momentum seems strong, and yet, just when you enter the trade, the market turns against you. It's frustrating, right? But when you understand the role of volume, these traps become easier to spot and avoid. A breakout is simply a moment when price pushes beyond a level that's been holding it back. It could be a resistance line, a support zone, or a range boundary. Traders watch these levels closely, and when the price breaks out, excitement floods the market. But not all breakouts are real. Some are just illusions, moves triggered by short-term enthusiasm, or even deliberate manipulation by large players. So how do you know the difference? The answer lies in volume. When a breakout happens with strong, increasing volume, it means many participants are involved. Buyers or sellers are stepping in with confidence, showing that the move has real strength. But when the breakout happens on weak volume, it's like a car trying to climb a hill without enough fuel. It might move a little, but it won't go far. A low-volume breakout often fails quickly, trapping traders who entered too soon. Imagine this scenario. A stock has been moving sideways for several days. Suddenly, the price jumps above the resistance level. The breakout looks strong, and traders rush in to buy. But if you look closely, the volume is flat or even lower than usual. That's your clue. Without rising volume, the move isn't backed by conviction. What often happens next is a pullback. The price falls back below resistance, and those who bought the breakout are forced to sell at a loss. That's how the market traps emotional traders. Volume acts as your truth filter. It reveals whether the breakout is supported by real money or just emotional reaction. If you learn to confirm every breakout with volume, you'll protect yourself from most of these traps. The same principle applies in the opposite direction, to breakdowns. When the price falls below support with heavy volume, it confirms strong selling pressure. But if the price breaks down with low volume, it could simply be a false move or a temporary shakeout before the next rally. Volume also tells you about the intentions of big players. Institutions often use breakouts to test market interest. They might push the price beyond a key level to trigger orders and see how the crowd reacts. If volume surges, they know there's participation and they may continue the move. If volume stays weak, they pull back, leaving retail traders caught in losing positions. By reading the volume, you can see this dynamic unfold and stay one step ahead. Another clue lies in the behavior after the breakout. If volume remains steady or increases as price consolidates above the breakout level, it's a sign of healthy demand. Traders are holding, not exiting. But if volume dries up and price starts to drift sideways or down, it signals hesitation, and the move may fail. The market loves to create illusions, false strength, sudden drops, sharp reversals, all designed to test emotional traders. But volume gives you the advantage of seeing beyond the illusion. It helps you understand not just what the price is doing, but why it's doing it and whether the move is likely to last. Remember, real trends are supported by commitment. Without that, price action is nothing more than noise. A breakout without volume is like thunder without lightning, loud but harmless. So before you react to any breakout or breakdown, take a moment to look beneath the surface. If volume confirms the story, you can move forward with confidence. If not, step aside and let the market reveal its real intentions. By using volume as your guide, you transform trading from guesswork into analysis. You no longer chase every movement. You wait for evidence. And in doing so, you begin to trade like a professional, calm, patient, and informed. 5. Liquidity, the hidden force of the market. Now that we've explored the truth behind breakouts and traps, let's move into one of the most overlooked but powerful concepts in trading, liquidity. If price is the surface and volume is the heartbeat, then liquidity is the bloodstream of the market. It's the invisible force that keeps everything moving. Yet many traders don't understand how it truly works. Liquidity simply means the availability of buyers and sellers at a given price level. In a liquid market, you can buy or sell easily without causing large price changes. In an illiquid market, even small orders can cause big spikes. But liquidity is more than just activity. It's where the real action happens. The price doesn't move randomly, it moves toward areas where liquidity exists. It's drawn to where the most orders are sitting, where stop losses, limit orders, and pending positions are clustered. Large institutions, the big players, depend on liquidity. They trade in massive volumes, and they can't simply press the buy or sell button like retail traders. If they tried to buy millions of dollars worth of assets at once, they would push the price against themselves. So what do? They create liquidity. They push price into zones where plenty of orders already exist, allowing them to execute their trades quietly. This is why you'll often see sudden spikes in price around key levels, areas that traders identify as support or resistance. Those levels are not random. They are magnets for liquidity. When price touches them, it triggers a wave of stop losses or pending orders, and that sudden activity provides the liquidity that large traders need to enter or exit positions. Understanding this concept gives you a completely new perspective on market movement. Instead of seeing sudden reversals as surprises, you start to recognize them as strategies. The market often moves to where it can find liquidity, not because of news or sentiment, but because that's where the orders are. By identifying these high liquidity zones, you can begin to anticipate where the next big move might start. Volume analysis helps you spot these areas. When you notice unusually high volume at certain price levels, it's a sign that something important is happening, either accumulation or distribution. If the price repeatedly touches a level and volume spikes each time, it means big participants are active there. Sometimes they're defending a position. Other times they're preparing for a breakout or reversal. Liquidity zones also explain why markets often reverse suddenly after hitting a major level. Once the liquidity at that level is consumed, meaning all those stop losses or pending orders have been triggered, there's nothing left to hold the price in place. The market then moves in the opposite direction, leaving many traders confused and trapped. For a retail trader, recognizing liquidity is like seeing the hidden map of the market. You don't have to guess where the next big move will happen. You can anticipate it by observing where volume clusters, where price stalls, and where sudden surges occur. Combine this with your understanding of price and volume, and you gain a powerful advantage. You begin to trade where the professionals trade. Liquidity is also tied to risk management. When you enter trades in low liquidity zones, slippage can increase. Your order might fill at a worse price than expected. But trading near high liquidity areas ensures smoother entries and exits. Professional traders always seek these zones because they provide stability and predictability. Think of liquidity as the bridge between intention and execution. It's what allows a trader's decision to become an actual market movement. Without it, price would jump unpredictably, making trading impossible. That's why understanding liquidity transforms you from a participant who reacts to the market into one who reads and anticipates it. So, next time you look at your chart, pay attention to where the volume spikes appear and where price hesitates. These are clues, footprints of liquidity. They tell you where big orders are hiding, where traps might form, and where the next strong move could begin. When you understand this invisible flow, you're no longer lost in noise. You begin to see the structure, the rhythm, and the logic of the market itself. 6. The power of patience and emotional discipline. Now that we've discussed liquidity, the hidden current that guides market flow, it's time to talk about the one quality that separates consistent traders from emotional ones: patience and discipline. No strategy, no indicator, and no amount of knowledge can replace emotional control. Trading success is built not just on analysis but on mindset, the ability to wait, to act without fear, and to accept losses with clarity instead of frustration. Every trader starts their journey full of excitement. The charts move, prices fluctuate, and it feels like endless opportunity. But soon, emotions take over: the desire to win quickly, the fear of missing out, the panic when a trade turns against you. The truth is, the market constantly tests your patience. It rewards those who wait for confirmation and punishes those who act out of impulse. Patience in trading doesn't mean doing nothing. It means doing the right thing at the right time. It's the skill of observing, analyzing, and waiting until the story told by price and volume aligns. A trader who jumps into every move will exhaust both their capital and their confidence, but one who waits for high-probability setups, where volume supports price and liquidity confirms direction, trades with clarity. Let's look at what discipline really means. It's not about being perfect. It's about following your plan, even when emotions try to pull you away from it. Every trader faces temptation: to double down on a losing trade, to exit too soon out of fear, or to enter early because the move looks good. Discipline is the voice that says, wait, check your confirmation first. It's the habit of obeying logic over emotion. After a winning streak, the most dangerous feeling is overconfidence. Success can create a false sense of control. The brain releases dopamine, that rush of satisfaction, and suddenly you feel unstoppable. But that's when risk becomes invisible. One reckless trade made with arrogance can erase weeks of discipline. The best traders know this and protect themselves by following a strict routine: fixed position sizes, risk limits, and mandatory breaks after major wins or losses. On the other side, losses can create fear, the hesitation to act even when the setup is right. The disciplined trader understands that losses are part of the process. They treat them like business expenses, not personal failures. Every loss carries information. It teaches you what to refine, not what to regret. Patience and discipline work hand in hand. Patience tells you when not to trade. Discipline tells you how to trade when you do. Together, they form the psychological backbone of success. Think of trading as a marathon, not a sprint. Impulsive decisions might win short-term battles, but patience wins the war. The market will always be there tomorrow. Missing one trade means nothing compared to the consistency you build over time. Emotionally stable traders understand that their greatest enemy is not the market. It's their own reaction to it. They know that greed makes them hold too long and fear makes them exit too soon. The goal is not to eliminate emotions, but to manage them. When you focus on process rather than outcome, emotions lose their grip. One powerful tool for maintaining discipline is a trading journal. Write down every trade: what you saw, why you entered, how you felt, and how it ended. Over time, patterns appear. You'll see where impatience cost you and where discipline saved you. This reflection builds self-awareness, and awareness leads to control. Patience also connects directly with volume analysis. Often, you'll see setups forming, but volume hasn't confirmed yet. The impatient trader jumps in, hoping for the best. The patient trader waits for validation. It's that simple difference, the extra moment of waiting, that defines consistent success. Remember, trading is not about action, it's about accuracy. You're not rewarded for trading more, you're rewarded for trading right. The market doesn't pay for effort, it pays for timing. When you combine patience, discipline, and an understanding of volume, every decision becomes calmer, sharper, and more precise. So the next time you feel the urge to jump into a trade out of boredom or fear of missing out, take a deep breath. Remind yourself that the goal isn't to trade often, it's to trade well. The market always gives another opportunity, but your capital and confidence take time to rebuild. Wait for the story to make sense. Wait for price and volume to agree, and then act with discipline. That's how professionals trade, and that's how you transform chaos into control. 7. Trends, strength, and market signals. Trends are the backbone of trading, the reflection of how money flows in and out of the market. But here's the key. Not every price movement is a real trend. Some are temporary bursts of excitement, while others mark the beginning of powerful, sustained moves. The difference between the two lies in one thing: volume. Think of a trend as a story being written over time. Price tells you what's happening, but volume tells you whether that story has real support. When a trend begins and volume rises steadily, it shows conviction, real participation from large traders and institutions. This means the move is likely to continue. But when a trend forms with weak or declining volume, it's like a song without rhythm. It may sound nice for a while, but it won't last. Let's take an uptrend as an example. When prices make higher highs and higher lows, that's a sign of strength, but only if volume confirms it. Rising volume on up moves and decreasing volume on pullbacks show that buyers are still in control. It's the market's way of saying, we believe in this direction. However, if you see price making new highs while volume falls, that's a red flag. It means fewer participants are supporting the move. The rally is losing momentum, and a reversal could be near. The same logic applies to downtrends. When prices drop and volume increases, it shows strong selling pressure. Big players are unloading positions, and the trend has real force behind it. But if prices are falling while volume fades, it suggests that selling pressure is running out. The market could be preparing for a bounce. These subtle changes between price and volume create signals, early warnings that often appear before the rest of the market reacts. That's the beauty of volume price analysis. It doesn't just describe what's happening. It helps you anticipate what might happen next. Another powerful concept within trends is the idea of exhaustion. Every move, no matter how strong, eventually slows down. You'll notice this when price continues to rise, but each push upward comes with less and less volume. It's as if the market is running out of breath. These moments often precede pullbacks or reversals. The opposite is also true. When price falls but each drop shows lower volume, it signals that sellers are losing control and the downtrend may soon end. Understanding this rhythm helps you trade with flow instead of emotion. Instead of guessing tops or bottoms, you listen to what the market is saying through price and volume. The goal isn't to predict every turn perfectly. It's to recognize when strength is building or fading and position yourself accordingly. Trends also reveal market psychology. In an uptrend, optimism grows and more traders join in, driving volume higher. In a downtrend, fear takes over and selling volume spikes. Eventually, when fear or greed reaches extremes, volume tells you that the trend has matured. It's the point where everyone who wanted to buy has already bought, or everyone who wanted to sell has already sold. That's often when the market reverses. When you combine patience, discipline, and volume awareness, you stop chasing trends blindly. You wait for confirmation, for the harmony between price and volume. This mindset protects you from emotional decisions and aligns you with the rhythm of the market. There's also another signal that experienced traders pay attention to: divergence. This happens when price and volume move in opposite directions. For example, the price keeps rising, but volume quietly declines. That's a warning sign of weakness beneath the surface. Similarly, when the price keeps dropping, but volume starts to rise, it suggests that buyers might be stepping in. These moments often signal turning points. Understanding trends is about observation. You're not trying to control the market, you're trying to interpret it. When you learn to read the relationship between price and volume, every trend becomes a clear conversation between buyers and sellers. You start to see when strength is genuine, when it's fading, and when opportunity is quietly building. So the next time you see a strong move on your chart, pause for a moment. Look beneath the price. Is volume supporting it? Is participation growing or shrinking? The answer to those questions can mean the difference between riding a wave and getting caught in its collapse. Follow the flow of money, not just the movement of price, and you'll always find yourself aligned with the market's true direction. 8. Volume and volatility. It's time to bring another crucial factor into focus: volatility. Together with volume, volatility forms the heartbeat of market movement. One shows participation, the other shows energy. When you learn to interpret them together, you gain a deeper understanding of when markets are stable, when they're preparing to move, and when they're about to explode with opportunity. Let's start with what volatility really means. Volatility is the measure of how fast and how far prices move within a given time. When volatility is high, prices swing quickly, candles stretch wider, emotions rise, and both fear and greed become amplified. When volatility is low, the market moves quietly, almost as if it's holding its breath before the next major shift. Now, volume and volatility are connected in ways that reveal the true state of the market. When both rise together, it signals strong activity. Traders are engaged, institutions are active, and energy flows freely. These are often the moments when trends begin or extend with conviction. But when volatility increases while volume stays flat or declines, it often means the market is unstable. Moves are being driven by emotional reactions, not genuine participation. For example, imagine a sharp upward move after some breaking news. If volume also spikes, it means the market is genuinely reacting. There's real buying behind the move. But if price jumps without a similar increase in volume, that move may not last. It's likely a knee-jerk reaction, a temporary surge of emotion that fades once the excitement passes. The same logic applies during panic drops. Heavy selling on strong volume can mark real fear and momentum, while fast drops on low volume often reverse quickly because they lack substance. This is why professional traders don't just watch price movements, they listen to how loud those movements are. Volume tells them whether volatility is healthy or deceptive. In calm markets, when both volume and volatility are low, traders often feel bored or restless. But these quiet periods are not meaningless. They are build-up phases. Think of them as the calm before the storm. During these moments, large players are often positioning quietly, accumulating or distributing before launching the next major trend. When that quiet phase ends, you'll see both volume and volatility rise suddenly, a signal that energy is being released. The key for traders is not to fear volatility, but to understand it. High volatility means opportunity, but it also means risk. The wider the swings, the larger the potential profit, and the greater the danger if you're unprepared. When volume confirms those volatile moves, it gives you confidence to act. When it doesn't, it warns you to stay patient. You can think of volatility as the weather and volume as the wind. A calm day with light breezes means small, steady moves. A storm, rising volume, and violent price action means major change is coming. By reading both, you know whether to open your umbrella or set your sails. Volatility also affects psychology. When prices move quickly, emotions intensify. Traders become anxious, decisions become reactive, and discipline weakens. The calm professional, however, understands that volatility is natural. They use it to their advantage, not as a trigger for panic. Volume helps you filter the noise of volatile markets. When price spikes are backed by rising volume, it's a sign that the move has structure. When price whips back and forth but volume stays low, it's a sign that the market is confused. Best observed, not traded. One of the most powerful signals in trading is when volatility expands after a long, quiet phase. That transition often marks the start of a new trend. If you combine this observation with strong volume confirmation, you have one of the highest probability trading conditions you'll ever find. In short, volatility shows the speed of emotion, and volume shows the strength behind it. When both rise in harmony, it's time to pay attention. Big opportunities often begin there. But when they move out of sync, caution is your ally. By mastering this twin relationship, you develop the ability to sense the market's pulse. You'll know when the energy is building, when it's releasing, and when it's just noise. That understanding transforms volatility from something to fear into something you can navigate with calm confidence. 9. The mental game of trading. Now that we've covered the forces of volume and volatility, it's time to explore something even more powerful: the mind behind the trade. You can learn every strategy, master every chart pattern, and still fail if your emotions control you instead of your logic. Trading is as much a mental challenge as it is an analytical one. It tests patience, discipline, humility, and emotional control every single day. The truth is, the market doesn't defeat traders. They defeat themselves. Fear, greed, overconfidence, and impatience cause more losses than bad strategies ever will. Every candle on the chart reflects a mix of these emotions, and the traders who learn to understand their own behavior gain an edge that no indicator can provide. Let's start with fear, the silent enemy of every trader. Fear makes you hesitate when opportunity appears. It makes you close good trades too early and avoid new ones after a loss. Fear is natural, but it must be managed. The way to overcome it is by preparation. When you trust your analysis, especially when volume and price confirm your setup, fear loses its grip. You're not reacting emotionally, you're acting on evidence. Then comes greed, the twin of fear. Greed whispers that you can earn more if you just stay a little longer. It convinces you to increase your lot size after a winning streak. But greed blinds you to risk. The disciplined trader learns to take profits logically, not emotionally. They understand that trading is not about winning big once. It's about winning consistently over time. There's another hidden danger: overconfidence. After a series of wins, your brain releases dopamine, the chemical of reward. It feels good, and you start to believe that you can't lose. But the market has a way of humbling anyone who forgets respect for risk. That's why even professionals follow strict rules after big wins, reducing trade size, taking breaks, and resetting their mindset before continuing. Discipline is the shield that protects you from all these emotional traps. It's the ability to follow your plan no matter what the market or your emotions say. Every trader needs a structure: entry rules, risk management, exit criteria, and review habits. Without these, decisions become impulsive, and impulsive decisions always cost money. A powerful tool for developing mental strength is keeping a trading journal, not just to record entries and exits, but to track how you felt and why you acted. Over time, you'll start to see patterns, moments when impatience led to losses, or when sticking to the plan brought success. This awareness turns experience into wisdom. Patience also plays a huge role in emotional control. The market will test you with boredom as much as with excitement. Waiting for the right setup can feel endless, especially when others are trading actively. But every great trader knows, trading less often usually means earning more. The best trades are those with strong confirmation between price and volume, the kind that require patience to identify. Mental strength also comes from acceptance. Losses are part of the business. You can't avoid them, but you can manage them. Treat every loss as data, not disaster. Ask, what can I learn? Instead of, why did this happen to me? When you see losses as lessons, they stop hurting and start teaching. Stress management outside of trading is equally important. Good rest, physical health, and mental calm directly influence decision-making. A tired or distracted mind is the enemy of discipline. Trading requires clarity, and clarity comes from balance. Ultimately, the mental game is what allows you to turn strategy into performance. Two traders can follow the same setup, but the one with emotional control will always come out ahead. That's because while markets are uncertain, your mindset doesn't have to be. Volume price analysis helps here too. When you can see what's truly happening behind the price, when you know whether a move is real or emotional, you stop panicking. You trade with calm confidence, guided by data instead of noise. When logic and discipline lead your actions, and emotion serves only as awareness, you reach the state every trader strives for: calm focus. That's when trading becomes not a battle, but a conversation. One where you listen, respond thoughtfully, and let the market reveal its rhythm. 10. The art of reading market reversals. Let's explore one of the most valuable skills you can ever develop: the ability to identify market reversals. Every trader dreams of catching the top before a fall or the bottom before a rally, but few understand how to spot these turning points with accuracy. That's because most people only watch price. The professionals, however, know that the real clues hide in volume. A market reversal doesn't happen out of nowhere. It builds quietly, step by step, as emotions shift and participation changes. The price may still be rising, but if you listen closely, volume begins to whisper that something is different. Momentum fades, activity slows, and what once looked like strength starts to show cracks. Recognizing these early signals allows you to exit before the crowd, or even prepare for the new direction before it begins. Let's break it down. Imagine a strong uptrend that has lasted for weeks. Prices keep making new highs and optimism fills the air. But suddenly, the volume behind each new push starts to shrink. Buyers are still there, but fewer of them are willing to pay higher prices. The market is running out of fuel. Then one day, a large red candle appears. Not massive, but noticeable, and it's supported by a sharp increase in volume. That's your first sign. Smart money may be quietly distributing their positions while the public still believes the trend will continue. Now imagine the reverse situation, a long downtrend filled with fear. Prices drop daily, and the news is full of pessimism. But one day, price falls again, yet this time, volume doesn't increase. It stays flat or even declines. Sellers are losing strength. Soon after, a green candle appears with a sudden burst in volume, the first sign of buying pressure returning. This is how reversals begin, quietly, logically, and visibly for those who watch volume carefully. One of the biggest myths in trading is that reversals are sudden and unpredictable. In reality, they leave footprints. Volume gives those footprints shape and direction. When you see divergence, price moving one way and volume moving another, that's a warning. If price is rising but volume is falling, strength is fading. If price is falling but volume increases, accumulation may be starting. A great way to confirm potential reversals is to observe tests of strength. After a strong uptrend, when the market dips slightly, pay attention to what happens with volume. If price falls and volume spikes, sellers are active. The top may be close. But if price falls and volume stays low, the trend might still have life left. Similarly, after a downtrend, if price rises and volume remains weak, it could be a false start. But if both price and volume increase together, the market is waking up from its fall. These moments require patience. Reversals take time to form. They are rarely one-candle events. Often, the market will retest the same levels several times before committing to a new direction. Volume tells you when the transition is real. It confirms that new participants are stepping in, replacing the old ones who are exiting. Emotionally, reversals are driven by exhaustion. In an uptrend, everyone who wanted to buy has already bought. Demand dries up. In a downtrend, everyone who wanted to sell has already sold. Supply dries up. Volume reflects these changes long before the chart makes it obvious. That's why professionals often seem to predict reversals. In truth, they're just reading volume with clarity. There's also an element of psychology in every reversal. When a trend has lasted a long time, people start to believe it will never end. That belief itself becomes the fuel for reversal. As soon as the first signs of change appear, the crowd resists, then slowly accepts, then finally panics, creating the very volume that confirms the new trend. When you combine patience, observation, and volume analysis, you begin to anticipate these turning points calmly. You no longer chase tops or bottoms out of emotion. You watch, you confirm, and you act with purpose. Every reversal is a story of transition, from optimism to doubt, from fear to hope. Price shows you the emotion. Volume shows you the conviction behind it. When you can read both together, reversals stop being mysteries. They become clear, logical shifts that you can identify, prepare for, and trade with confidence. 11. Support, resistance, and the message in volume. Every trader draws these lines on their charts, but few truly understand what they represent. Support and resistance are not just price levels. They are psychological zones of power, areas where human behavior, liquidity, and volume all intersect. Support is a level where buying interest is strong enough to stop price from falling further. It's where demand comes alive. Resistance is the opposite, a level where selling pressure stops price from rising higher. These levels exist because traders remember them. They represent emotional reactions, places where people previously entered trades and now make future decisions. But here's where it gets interesting. Price alone cannot confirm the strength of support or resistance. Volume tells the real story. When price touches a support level and volume spikes, it signals real buying activity. Strong hands defending that zone. If price bounces from support with little volume, the move might be weak. just a temporary reaction. The same applies to resistance. When price hits a ceiling and volume increases sharply, sellers are active. But if price stalls without much volume, resistance might not hold for long. Think of these levels as emotional checkpoints. When traders see price return to a previous high or low, they remember their past experiences. Those who bought before might take profits. Those who missed the move may enter. Those who lost before might try to recover. This emotional mix creates volume, and volume creates the reaction. Now, the real power comes from combining volume and price behavior. For example, suppose price breaks above a resistance level. Most traders celebrate, they see a breakout. But the wise trader looks deeper. Was the breakout supported by volume? If yes, that resistance has truly been overcome, and it often turns into new support. But if the breakout happens on weak volume, it's often a trap. The market may fall back below resistance soon after, catching emotional traders off guard. Similarly, when price drops below a support level, it doesn't always mean the market is weak. If volume is low, it might be a false break, just a test to trigger stop losses before reversing upward. High volume confirms real selling pressure. Low volume suggests manipulation or temporary imbalance. Support and resistance also evolve with time. Once a strong resistance is broken with heavy volume, it tends to become new support because the same traders who sold before now start buying in that area. This role reversal happens constantly, and volume helps you confirm when it's real. Understanding this dynamic changes the way you view charts. You stop drawing lines mechanically and start interpreting zones of interest, areas where real buying and selling are happening. You begin to ask, is this level backed by participation? Is there conviction here? Another powerful insight is watching volume clusters. When you see volume build repeatedly around a particular price range, it means that area is significant. It's where large players are positioning, either accumulating or distributing. When the market later returns to that range, reactions are often strong because many traders have open interest there. Emotionally, these zones reveal the battle between hope and fear. Support forms when buyers believe the market is undervalued and step in with confidence. Resistance forms when sellers think the price is too high and begin unloading. Each bounce or rejection at these levels represents a clash of conviction, and volume is the proof of who's winning. Over time, you'll notice something fascinating. The most powerful moves happen after the market tests these zones multiple times. Each test builds pressure, storing potential energy like a spring. When the breakout finally happens with a surge in volume, that energy releases, driving large, fast moves. That's why professionals wait for confirmation from volume before acting. They know patience pays. So remember, support and resistance aren't magical lines. They're reflections of trader psychology, memory, and participation. Volume transforms them from static drawings into living, breathing zones of decision-making. When you read volume at these levels, you don't just see where the market might pause. You understand why it's pausing and who is active there. Next time you draw those lines, ask yourself, what story is volume telling here? Are buyers truly defending this level, or is it just an illusion? Are sellers losing strength, or are they building for another attack? The answers to those questions will guide your trades far more effectively than price alone ever could. When you blend volume with support and resistance, you begin to read the market with precision. Not just reacting to lines, but interpreting the emotions and forces behind them. And that's what turns a trader from a follower into a reader of the market's true language. 12. Accumulation, distribution, and the footprints of smart money. It's time to uncover one of the most insightful concepts in market analysis: accumulation and distribution. These are the secret footprints of smart money, the quiet buying and selling activities of large institutions and professional traders who move markets while most retail traders remain unaware. The truth is, the market rarely moves by accident. Every major rally or crash begins with a phase of preparation. Accumulation and distribution are those hidden stages, the calm before the storm. When you learn to spot them through volume and price, you begin to see the market through the eyes of professionals rather than the crowd. Let's start with accumulation. This phase happens after a prolonged downtrend or a period of weakness. Prices are low, sentiment is negative, and most traders have given up. While the crowd sells out of fear, professionals begin quietly buying. They don't rush, they accumulate gradually, building large positions without drawing attention. During this phase, the price often moves sideways within a range. But here's the clue: volume increases subtly. Each dip in price is met with stronger volume as buyers step in. The market appears calm on the surface, but beneath it, strong hands are preparing for the next big move. When accumulation is complete, the price begins to rise steadily. You'll notice that up moves start to appear with higher volume, and pullbacks occur on lighter volume. That's the sign that demand is overpowering supply. The professionals have finished their buying and are now allowing the market to move naturally upward, drawing in the public who once feared to enter. Now let's look at distribution, the opposite of accumulation. This phase occurs after an uptrend when optimism is high, news is positive, and everyone believes the rally will never end. That's when professionals begin to quietly sell their holdings to the public. Once again, they don't do it all at once. They distribute gradually, selling into strength while the crowd continues to buy. Price action during this period often looks like sideways consolidation near the top, with repeated tests of resistance. The key to identifying distribution lies in volume. You'll notice that volume spikes appear on up days, but price doesn't move much higher. This shows selling into strength. Later, when price starts to fall, volume remains heavy, proof that supply is overtaking demand. The market then transitions from bullish to bearish as the professionals complete their distribution and step aside. Understanding these two phases is like learning to read the pulse of the market. Accumulation tells you where opportunity begins. Distribution tells you where danger starts. The difference between the two is not found in price alone, but in the behavior of volume relative to that price. One common trap for traders is mistaking distribution for continuation. When they see sideways movement after an uptrend, they believe it's just consolidation before another rally. But if volume spikes during that range and price fails to make new highs, it's a warning. The smart money is exiting. The opposite mistake happens in accumulation. When prices move sideways after a fall, traders often assume it's weakness, but rising volume at the lows reveals quiet buying. The psychology behind these phases is fascinating. During accumulation, fear dominates. Retail traders are still scarred from previous losses and hesitate to re-enter. Smart money takes advantage of that fear, buying at discounted prices. During distribution, greed dominates. Retail traders, seeing continuous gains, rush in late, driven by emotion rather than logic, exactly when professionals are offloading their positions. By combining volume with price action, you can spot these emotional transitions early. Watch for shifts in behavior. When price stops falling but volume starts to rise, think accumulation. When price stops rising but volume spikes without progress, think distribution. These insights are powerful because they allow you to align with the market's strongest players instead of fighting against them. You don't need to know who they are. Their footprints are visible in volume. Every large order, every phase of buildup or unloading leaves a trace that tells a story. So the next time you see a quiet range after a big move, look deeper. Ask yourself, is this accumulation or distribution? Is smart money buying what the crowd is selling or selling what the crowd is chasing? The answer is always in the volume. Learn to see those footprints and you'll walk the same path as the professionals, calm, confident, and one step ahead of the crowd. 13. Reading the story behind candles and volume bars. By now, you understand how accumulation and distribution reveal the quiet actions of smart money. But to truly master volume price analysis, you must learn to read the market story on a smaller scale. Candle by candle, bar by bar. Each candle and each volume bar is a sentence in the language of the market. Together, they tell a complete story of conflict, emotion, and intention between buyers and sellers. Every price bar is born from human behavior. Behind each one are countless decisions. Someone buying out of hope, someone selling out of fear, someone waiting with patience. When you learn to read candles not as random shapes, but as emotional expressions supported by volume, you start to see the truth that lies between the lines. Let's begin with a simple example. Suppose you see a long green candle showing a strong price rise. At first glance, it looks bullish. But before celebrating, you must ask, what does volume say? If volume also increases sharply, it confirms strong buying pressure and real enthusiasm. Buyers are in control. But if the same green candle forms on weak or average volume, it may be misleading. The price moved, yes, but few participants supported it. That means the move could fade quickly. Now imagine a long red candle. Price drops sharply in one session. If volume is high, it shows panic selling or heavy liquidation. That could be the start of a trend, or, interestingly, the end of one. Sometimes, extreme high-volume red candles appear at the bottom of a move, marking capitulation, the moment when fear reaches its peak and smart money quietly begins buying. This is why you should never judge a candle by its color alone. The true message always depends on the relationship between price movement and volume. Another fascinating signal comes from candles with long wicks or shadows. A candle with a long upper wick shows that buyers tried to push price higher, but sellers pushed it back down before the close. If this happens on high volume, it reveals strong selling pressure, a warning of potential reversal. On the other hand, a long lower wick with high volume tells the opposite story. Sellers tried to drag price down, but buyers stepped in strongly, showing hidden strength. These moments often mark turning points when read in context. You'll also notice periods where volume stays low while price drifts sideways. Small candles, tight ranges, quiet market behavior. These phases may feel uneventful, but they're often the build-up before the next big move. When you suddenly see a wide candle with a spike in volume after such a phase, it usually signals the start of a new trend. That's the market waking up. Volume also helps you interpret false signals. For example, a candle pattern like a hammer or engulfing bar means little without volume confirmation. A bullish engulfing pattern with weak volume is just decoration. With strong volume, it becomes powerful evidence of reversal. In other words, price shows intent and volume proves conviction. As you start watching candles and volume together, you'll begin to recognize rhythm. Strong moves have a pulse. Rising volume on directional candles, falling volume on retracements. Weak moves feel inconsistent. Candles stretch without volume, or volume spikes appear without meaningful price progress. These imbalances are clues that help you avoid traps. You can also read the story of transition within clusters of candles. For instance, a sequence of strong bullish candles with declining volume suggests that momentum is fading. A few candles later, a sudden surge in volume on a small bearish candle signals the shift. The crowd is losing strength, and the professionals may be preparing for a reversal. One of the most powerful realizations comes when you stop reacting to single bars and start reading context. A high-volume candle means one thing in the middle of a trend and something entirely different at the end of one. It's all about timing and placement. That's why traders who treat each signal in isolation often fail. They miss the narrative. To become fluent in this language, practice observing without judgment. Look at each session and ask, who was in control today? Buyers or sellers? Did volume confirm their strength or expose weakness? What emotions are visible here? Excitement, fear, exhaustion, hesitation. When you start answering those questions instinctively, you're no longer guessing, you're interpreting. Remember, every candle and every bar of volume is a footprint of behavior. Price shows you what the market did. Volume shows you how much belief stood behind that action. When you combine the two, you read not just charts, but the psychology of the crowd. And that's what separates surface-level traders from true market readers. 14. Confirmation, timing, and the power of waiting for proof. As you've seen so far, price and volume work together to reveal the truth behind every move. But even when the signs look clear, the greatest mistake most traders make is jumping in too soon. They act on half the story, driven by excitement or fear of missing out. Today, we'll explore the quiet strength of confirmation, the art of waiting for proof before acting, and how timing built on patience can turn good analysis into consistent results. Confirmation is simply evidence that supports what your analysis already suggests. In trading, it means waiting for both price and volume to agree. If you see a breakout, you wait to see whether volume supports it. If you see a reversal forming, you wait for follow-through before committing. This waiting period might seem small, but it's the difference between being a professional and being emotional. Think of the market as a conversation. Price speaks first, giving you a signal. I might be moving up. Volume answers back. yes, I agree, or no, I don't. When both speak the same language, you have confirmation. Without it, you have noise. Let's take an example. Suppose you see a stock breaking above a key resistance level. The candle looks strong, and the pattern fits your setup. Many traders jump in right there, but a professional waits for volume to confirm. If volume surges during or immediately after the breakout, it means real participation, a green light to act. If volume remains flat, it's a yellow light. Proceed carefully, or not at all. The market often fakes a move to trigger emotional entries, only to reverse. Volume keeps you safe from that trap. The same applies to breakdowns. A price drop through support might seem bearish, but if volume is light, it could simply be a false move to shake out weak hands. True selling pressure always leaves its mark through higher volume. Confirmation also protects you during reversals. When you think a bottom has formed, don't assume. Wait for price to rise with conviction and for volume to expand. It's the proof that buyers are stepping in. In other words, don't predict, confirm. This habit of waiting for evidence goes beyond setups. It's a mindset. It trains your emotions to stay calm. You no longer chase, you observe. You wait for the market to prove itself before you risk your capital. The impatient trader always wants to be early. The disciplined trader wants to be right. Timing in trading is not about speed, it's about synchronization. The perfect entry isn't necessarily the first one, it's the one that aligns with real momentum. Volume is your timekeeper. It tells you when the crowd has joined the move and when the energy behind it is strong enough to sustain direction. You'll also notice that timing applies to exits. Many traders know when to enter, but not when to leave. They hold on to trades too long, waiting for one more candle, one more gain. But if you see price continuing in your favor while volume starts to fade, that's your early warning. Momentum is slowing. The professionals may already be taking profits, recognizing that subtle shift helps you lock in gains before the market turns. Patience in confirmation also builds confidence. When you know you waited for proof, you no longer second-guess your trades. You act decisively because the evidence supports you. And if the trade doesn't work out, it's not because you were careless. It's simply part of probability. That calm confidence comes only from experience and discipline. Remember, the goal of confirmation is not to eliminate risk, but to reduce uncertainty. There will always be unknowns, but your job as a trader is to minimize emotional decisions and maximize logical ones. Volume gives you that logic, the proof behind price. Think of each trade like crossing a river. You can jump at the first sign of stepping stones, or you can wait until you see which ones are solid. Waiting a little longer may cost you a few points, but it saves you from falling into the water. In the same way, waiting for confirmation might mean missing the first few ticks of a move, but it dramatically increases your chance of success. In the long run, this patience becomes your greatest edge. The market rewards discipline, not speed. The traders who last are not those who act first. They're the ones who wait for the right moment when all signs align. 15. The harmony of price, volume, and mindset. We've now reached the final part of this journey, where everything you've learned comes together into one complete vision. You've explored how price moves, how volume confirms strength, how emotions shape behavior, and how discipline turns knowledge into results. Now it's time to see the big picture, to understand how these pieces work in harmony to create clarity, confidence, and consistency in your trading. Trading is often seen as a game of prediction, but in truth, it's a game of interpretation. The goal is not to know what will happen next, but to understand what is happening now, clearly, without confusion. Price tells you the market's movement, volume tells you the conviction behind that movement, and your mindset determines how you respond to both. When these three elements align, your trading becomes balanced, calm, focused, and purposeful. Let's bring this concept to life with a simple flow. First, identify the trend, the broader direction of the market. Next, observe the volume. Is it confirming or contradicting that direction? Then watch for phases, accumulation, breakout, distribution, or reversal. Finally, act when both price and volume align and manage your emotions as calmly as you manage your chart. When you trade this way, every decision feels deliberate. You're no longer guessing. You're interpreting evidence. You're not chasing opportunity. You're waiting for the market to invite you in. Volume price analysis isn't just a technique, it's a perspective. It teaches you to see the market as a living, breathing organism, driven by energy and emotion. It gives you the ability to read that energy in real time, to understand where power lies, and to position yourself accordingly. And perhaps the most beautiful part of all this is what it does for your mindset. When you trade with clarity and logic, fear loses its grip. You no longer panic during drops or become overexcited during rallies. You see both for what they are, movements within the larger rhythm of the market. This calm awareness turns trading from a stressful chase into a disciplined craft. Every candle, every volume bar, every pause becomes meaningful. You learn to wait, to listen, and to act with precision. Over time, trading stops feeling random and starts feeling like a skill, one that rewards observation, understanding, and emotional mastery. So, as you reach the end of this journey through volume price analysis, remember this: the market is always speaking. Its language is price. Its voice is volume. When you learn to listen with patience and think with discipline, you begin to hear its message clearly. It will tell you when to move, when to wait, and when to walk away. And in that harmony of knowledge, patience, and awareness, you'll find the true edge that every trader seeks. Not just profit, but peace of mind. The quiet confidence of knowing that you finally understand the rhythm of the market. If there's one message to take away from this book, it's this: price tells you what the market is doing, but volume tells you why it's doing it. When you learn to combine both, you stop guessing and start understanding. You begin to trade with clarity, confidence, and calmness. If you found this summary helpful, don't forget to like the video, share it with your fellow traders, and subscribe to the channel for more detailed book summaries, psychology lessons, and real-world trading wisdom. Also, let me know in the comments, which part of this book resonated most with you? Was it the power of patience, the psychology of volume, or the way Anna Coulling explains the footprints of smart money? I'd love to hear your thoughts. Thank you for watching, and always remember, trade smart, stay patient, and let volume be your guide. See you in the next video.